following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good morning, everyone. Thanks for joining us here at TFNN. I want to start the show by a comment. Last week I made a comment about the fact that Kermit and Miss Piggy were getting divorced on Sesame Street, which I don't think Jim Henson would have allowed that, but that's the way it is. But on top of that, on Friday, that famous U.S. retailer, Target, decided that they are going to take away pink and blue designations for children. Blue, of course, for boys, pink for girls, because it was too gender specific. You know, what has come to us here in the United States where a few parents can complain about something like that and they decide that they're going to change it. Pink and blue has been going on forever. That's like trying to not think about a green elephant. Hello? I mean, all you have to do is tell the people, well, sir, if you don't like it, go shop at Walmart. I mean, that's baloney. You got to draw a line somewhere. I mean, pink and blue? I mean, give me a break. But on top of that, the Major League Baseball announced this morning that any baseball player that spits on the field will be fined $500. Any baseball player that happens to, scratch his crotch will be fined $700. So pretty soon, that's what's going to be happening. Everybody's going to be fined for something else. So we got to draw the line here. So we'll have to see, what's going on for some of this stuff. But it's really frustrating when you see something like that happen from my point of view. I mean, God, you've got to just draw the line somewhere. Okay, I want to start out the show with the Fed funds rate here, going back over the last 20 years, the last 17 or 18 years. You can see the big ABCD pattern in the Fed funds. Basically this describes pretty much what's happening to quantitative easing when they've changed the normal cycles in the market. So that's something that we need to, really need to focus on. But if we take a look at what's happened to Fed funds here over the past, this is just in the last couple of years here, we've had an interesting situation happen on this last week here. I'll point it out to you. What this means, I'm not sure. All I know is Fed funds are traded. They have a contract for it. It's $5 million, and you can trade Fed funds, which are the rates between the banks. That's the banks, the bank rating stuff that they do. So this must mean something because we had this big gap down this past week, and we'll see if anything really occurs to this. This was furnished to me by my good friend Jim Bartolioni, and he does a lot of work, looking at interest rate futures and things like that. Now we have a pattern that is completed here in Treasury bonds last night. We'll start out by looking at the daily going back over the last several months, and you'll see that we made the ABCD pattern up at the 61% retracement with that particular vehicle. And then we also, if we look at it on a little bit shorter time frame, looking at a 4-hour chart, you can see we made a 3-drive to a top pattern up at the 1.618 level. And we've already dropped one full handle from 158 down to the 157 and change level. So that tells us that interest rates, at least on a short-term basis, over since last Friday, have started to rise. We're seeing the same thing occurring in the market for the Treasury notes. Only Treasury notes could not take out those highs. They were still below the highs of August the 2nd. They could only go up to the 786 retracement. So that divergence is also a important thing. Now, I know everyone has an interest in what's happening with the stock market, so we'll probably, we'll definitely start out with that. And I wanted to start showing you basically last Friday we hit some really key levels here in some of these things, and we'll take a look at the New York Stock Exchange Index first because that's the one that I follow the closest. And we went down and we made a beautiful ABCD pattern right at the 1.618, and now we're getting ready to. This is an hourly chart going over the last couple of weeks, and we should be in a mode for rallying, which is in fact, what we're doing this morning. If we do the same thing with the E-mini S&P, you're going to see a similar situation. It's been a little more bullish than the New York Stock Exchange Index. And here also is an hourly chart, and it's going to be showing that area of that John Logan pointed out, that from 2085 up to 2088 would be the first spot where you would see some resistance coming in at that point. Folks, we have a situation where the market is under incredible amount of selling whenever time it rallies. The breadth is just horrible in this market. It's worse than it was in 1987. It's very, very bad. Now, we've got a real key cycle date here coming in here on Thursday, and whether the market will be rallying up into that one or going down, I'm not sure yet. It's still early, but we've hit some pretty significant patterns here on the downside as of Friday, and we want to be able to see what this rally is going to do. But if we take out those lows that we made on Friday, that would be a really different situation. Now, if we take a look at also looking at a 4-hour chart and looking at another index, which is the Dow Jones Industrials, we went down and we made a new low in the Dow than July. Now, we didn't do that in the S&P. We didn't do that in the NASDAQ. But the Dow, I think for the first time in 6 years, actually had 7 down days in a row. And now we're up today quite a bit. We're up 100 and some points. So we'll see what this rally is going to bring us. But the overall market is very bearish. I mean, it is already turned down, and we will see these, really big rallies, and how far they're going to go. We won't know. We'll look at some numbers on the way up, but that's basically, what we're looking at. We've got a really, really negative situation in the market. Index-wise, it's a question of how much it's going to rally. That's the key. Now, much of this started last night in Germany. If you'll give me a second here, I'll pull up the German DAX and let you see what that looks like, because it was very interesting last night. You'll be able to see, it had a really big move, because I'm going to mark this so that we'll be able to see the opening. I got some lines on here for my own use, and I wanted to be able to show you what it means to me. But we've got a situation where the German DAX gapped up last night, where you see that red box. That's where the gap was. It was exactly at the 786 of the previous day's high, and then it proceeded to drop 150 points down to the 1.618 expansion, and that was exactly an ABCD move at that point. And from there, we went back up and took out the day's high, going back testing the 786 retracement. So you're seeing some really wild swings in some of these markets, which was exactly what you want to see. So that's the key to be watching when we're looking at some of these things from a shorter term perspective. But a lot of times the things will start in Germany in the middle of the night. That's around 3 in the morning, New York time. And it will really start to pick up, and you'll see some, really active swings in the market. So we want to watch it, very, very closely as we watch it unfold. Now, we had a situation in one particular commodity that deserves our attention. It's been under a great deal of pressure, as have all commodities. In fact, let me put the big commodity chart up, because that's the one that, just to show you how bad things are in the old commodity business, Cargill has shut down their Black River operation. It's been going on forever. That's their commodity trading group. There were 4 hedge funds in that group, and they've all decided to give their money back. And but as you can see, we're making new lows in the CRB index below 2009, and that was at the depths of the depression. And I'm asking myself, why is the transportation so weak, and why are commodity prices so weak, and why are we getting this bad news out of China? Who knows? But bad news out of China didn't mean much today, folks, because the Chinese market was up almost 5% at 4.9%, and that was due to a sector and the shipping index. They have limits on their trading in the futures markets over there, and all of their shipping indexes were up the 10% limit, and they were lock limit. There was no more trading there, which means they'll probably open higher again tomorrow. But this is as we know, it is a manipulated market. They can close it when they want to, and they can open it when they want to. So we have to. Hey, they can do the same thing to ours too. So let's not talk too much about that on this particular thing that we're watching here. So that's what the commodity index is really getting hit. But we're starting to see signs, and I'm going to go over the gold and silver again, because this open interest that we have in the shorts in the hedge fund business. They're at the highest short position they've had since 2003, when gold was at 260. Their highest long position was on the high at $1,932 per ounce. So it's really ripe for correction. I wanted to share some of those things that might be of interest to us. But we do have one commodity that has the PhD in the market, and that is the copper. And I wanted to show you what's happened to copper last night, because it might be early, but at least it's a first sign that something could be happening in copper that is of interest to us. So let's just pull it up here. We'll take a look at it, and you'll see. Give me 1 second so I can get it up, and we'll be able to see it really clearly. But we've had a beautiful, hold on, I've got to put the thing in. For some reason I lost it, and I don't want to, shucks. Give me 1 second here. I've got to do it just a little bit differently here. It was all ready to go, and then when I hit the button, it jumps out of my sight, and I don't know why, but that's neither here nor there. But we did make new lows on copper for this cycle, which is not surprising, because it's been going down forever. We've hit a long term, and I'll show that in just a second. I'm trying to show the short term first before I do that. There we go. I should be okay. Yeah, there we are. We're almost ready, boys and girls. Mr. Rogers will have it ready in just a minute. Okay, there we go. Here it comes. This is the chart for copper over the last couple of weeks. And as you can see, we made a 3 drive to a bottom pattern down here today at the 1.27 of the August low. We've now rallied almost 5 cents a pound already this morning, from 231 up to 236. That's an indication that there's something that could be happening in copper that would be very, very interesting to us. Now, if we take a look at copper on the very, very long-term basis, and I'm going to put this one up here to let you folks see that one also, and all I need to do is to find it. Doggone it. I've got to get a system to put these together. I thought I had one, but it's just not working for me today. My eyes are not catching it. We've got to take a little break here, and I'll see if I can find that long-term copper chart. Oh.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened, and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've found the chart for copper that I wanted to show. It's a long-term monthly chart, and as you can see from the high we made in 2011, we're completing a BCD pattern down here at the 230 area. We hit 231 last night, and we've rallied a little bit. We did have that nice butterfly pattern on the hourly chart. Excuse me, that was a 3-drive pattern on the copper, and whether that's going to mean anything or not. Since we're on the metals here, I wanted to go through a couple of other things. Now, we've also been watching gold and silver very, very closely here because of the fact that we have the hedge funds are in such a really strong short position. They believe that these things are going to go down forever, I guess, just like they believe they were going to go up forever when it was at 1932 per ounce in gold, and so they have the largest short hedge position that's not hedge, but their largest short spec position on the short side since 2003 when gold was bottoming at $260 per ounce. So long term, the trend is down. There's no arguing about that, folks. But if you'll look at this, even during after the top was made, there were 4 rallies of well over $15,000 or $20,000 during the move down from September of 2011 to then. So this is what I'm looking for. Is I'm looking for a rally of around between around $150. But since this is their record of what they've done so far, is that most probably will be a little bit more. Now, when we get above 1140 per ounce in gold, if we ever get above 1140 in the gold, that would be a trigger, because that's when most of the big short selling occurred, during that big breakdown when we broke from 1140. That I think it was on the 27th, when we broke from 1140 all the way down to the 1065 area, which was the longer term ABCD on the long-term daily chart. That was one of our two targets. We had one at 1065, and we had another one at 1047 per ounce in gold. So that's something. Now, remember that silver did not take out the lows of this past run. It didn't take out the lows of last November, which came in at 14.10 per ounce. We got down to 14.32, and now we've rallied up to, we hit almost hit $15 again last night. But the market is acting, it's not acting as bearish as it should, given the fact that we had new lows in copper today. Platinum made new lows last week, but only by less than $1 in platinum. It made a lower low by less than $1 and promptly rallied $22 per ounce. Palladium made a lower low by several dollars, and it went back above the previous low level, and hasn't closed higher, but it's close. So these are little signs that are telling us that be careful being short in here, because if it starts to go, it could really be dramatic, because that's what's happened in the past. And there are some people looking at something like this, but believe me, there are not very many people that are watching for something like this. It's just it's a rare situation when you have hedge funds that move, so much in one direction. Now, if you remember last week, our good buddy Arch Crawford, and we're going to have Arch on hopefully this week, sent us a chart on the what commodities have been doing over the past several months. And as you can see, it's been a free fall since July, with gold and copper and even corn, getting hammered quite a bit. And these are nothing like what's happened in rubber, in steel, and iron ore, and other things like that. That's what brings that Commodity Research Bureau index way down below the lows in 2009. And the question that I have to ask myself is, why can these prices be lower than 2009 and prices for stocks and be so high? This is an aberration that we don't see very often, and it's coming at a time when we have some other statistical things in the market that tell us that there should be some really caution up in here. But the VIX index is not showing any caution at all. All it could do Friday, even with the market down, could only make a 61% retracement of the previous day's high. And they were showing you there was no fear in the market. And then we made all those ABCD patterns late Friday that was telling us that, at least from my perspective, this market didn't want to go down. It could have gapped down big time over the weekend, but I didn't think that it was going to, for the fact that so many of those ABCD patterns had formed, and we had some divergence where the Dow had made lower lows than July, but we didn't even come close to that in the NASDAQ, and nor did we come close to it in the S&P. So these are things that telling us that we're in the midst of a rally. I think it's a 3 to 5 day rally, so we'll have to find out what's going to happen with us. But we're going to take a little break now to pay a few bills. We'll come back. We're going to talk a little bit about the divergence in Treasury notes.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization optimization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're looking for a great opportunity to diversify your financial portfolio, consider the Principal Protected Market Safe CD from Everbank. They've just released the second running of their 5-year Market Safe Power Metal CD, which combines the power of gold, silver, and copper. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your deposited principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Intrigued yet? The August 17th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN. Everbank is a member FDIC.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we've got the Dow opening up 155, but some of the Dow stocks haven't even opened yet, so it's probably going to be more than that. We've got the Nasdaq up almost 40. We got the S&P up 16, so it is definitely risk off again. And that was one of the things. First of all, let's do the Treasury notes to show you the divergence that we were seeing here in between the Treasury notes and Treasury bonds. As you can see from this chart, we had a situation where we made higher highs in the bonds, but not so higher high in the notes. That's a bearish indication because notes are so much more heavily traded than the bonds, about 5 or 6 times as much. By the way, there was a correction on one of the charts that I posted. I posted it as the NASDAQ hourly, and actually that NYA is the New York Stock Exchange index that was making the ABCD down on Friday at the 61% retracement. So that's one of the things that we want to be watching. Now, the next chart that I wanted to show you is one that we watch because many times, people move their money between stocks and bonds, and when there's virtually what they feel is no risk in the market, they will be, be selling stocks and they'll be buying stocks and selling the bonds. And this is what we had on Friday. Is we had this thing inverted, which basically tells us that there was no risk in the market, and there people were willing to come in and buy the stocks. So you can see as bonds were rallying, the stocks were falling down, because the green line that you're seeing there is the inverted line between, in other words, stocks were going down and bonds were going up. And as you notice the lower tops in this was telling us, at least it was telling me, that the market was certainly in a position where it didn't really care whether there was any risk involved or not. And that's exactly what we're seeing in the with the VIX index of what we had, and we'll see what's happening. But this is the first day off the bottom, so we could get one heck of a move in it, which we've already had. We're almost up 200 points in the Dow, in the matter of the first few minutes. But longer term, folks, I don't see how anybody can view this as bullish. I could be, totally wrong, which I am many times, but we'll have to, see what's happening. Fortunately, the market was telling us Friday that it certainly wanted to try to find a bottom down there, making all of those ABCD patterns. Whether they'll hold up or not, we'll wait and see. And we're seeing this in the bond market too, because people are moving money out of bonds and they're putting them into stocks again. So we'll keep an eye on that one also. We've gone above some really key levels. We went above the 1.618 of the last move in the S&P. That came in at 2090. We're trading pretty much right there right now. And we went and took out the highs of that last move in the Nasdaq. You talk about a market that is, totally on steroids. We took out the highs from August 7th by quite a bit, and we're almost we've already exceeded the 61% retracement, which came in at 45.60. That happened with the John Logan brought that to our attention. That, I believe, that was one of his profile points. So we did make that, and but we'll have to allow the market to see what's going to happen. Usually, when the market gaps up like this, folks, everybody has to be in it. They've got to buy it, and most of these guys in the hedge fund business, it's not their own money. They don't have any skin in the game, and they don't have any qualms about buying strength or selling weakness, which sometimes that can be the greatest thing in the world. But, if you're trying to manage your risk, it's really hard to buy into a market that is, just going absolutely, straight up. So you have to sort of respect that, and but that's what it's done, and you'll have to see, how it finishes. All I know is if we go below the low we made here on August the 7th, we are going down big time. I think we're going down big time no matter what. The question is it going to be from an area that is going to be higher than the level where we are right now, or we'll wait and see. We've already gained back. Oh my goodness! I just saw something here. This is a very interesting chart too. We're almost, we did hit it. Wow, we hit the 61% retracement of the all-time high in the Nasdaq. We missed it by 1 point. Wow, I wonder if that means anything. We'll have to take a look at this. Haven't had a chance to review this yet, but we made a 1.618 of expansion off of Friday. That came in at 45.60. The 61% retracement from the high that we made way back, back in late July, came in at 45.70, and we got to 45.66. So we've hit a really key level here this morning, and whether that's going to hold or not, we'll wait and see. But gapping up like this is usually, not the thing to do. But this is the way markets act, and you have to respect that without any problems. Now I want to go over this situation that we have in the gold and silver again, because there's a couple of things that could affect these markets by quite a bit. And one is the fact that we have the currency situation with the Australian dollar is basically really dependent upon commodities like oil and copper and gold and aluminum and things like that. And what we want to do is, if we look at the long-term chart on the Australian dollar, you'll see that, it's making this 135 higher bottom pattern, going back to the bottom in 2000. And then in 2009, we had the point 0.3, which was a 61% retracement of that move. And now we've had an equal parallel move down from 2011, ending pretty much right where we hit the bottom down there at 72 in the Australian dollar, and we rallied a couple hundred pips off the bottom from that. Could this be another indication that we're looking at a situation where we might be turning in some of these metals? I don't know. I'm basing it on the fact that the open interest is so high and you don't want to stand in front of that. And so that's the primary reason of what I'm looking for, with this Australian dollar. And also the New Zealand dollar is doing exactly the same thing. And so we have a potential for some major bottoms occurring here in these things, and with this open interest so skewed that it's you got to pay attention to that if you follow open interest, and I do, because back when gold was topping at 1932 per ounce and silver was 49.50, we were screaming that this was a short covering rally because the market was going up, and as the market was going up, open interest was decreasing. And when that happens, that's short covering. You got shorts going out of the market, and longs have liquidated their positions, and that means open interest is dropping. When you have open interest increasing and prices going down, you've got new shorts coming in to the market. You also have new longs, but the shorts are in stronger position because the prices are going lower. Now, if prices go back above 1140 per ounce someday in the future, then they're going to be trapped, and that's when you're going to see the big short covering rally to look at it. But trying to find a bottom down in here is a lot less risky because you don't have to risk as much. So that's why I'm watching this so closely to see what's really trying to happen here. I'll put this chart up to show you where I think the shorts will start to cover. It's around 11.30 an ounce. Right now we're trading at 10.95 in the gold. Last night we made a 50% retracement of the low from Friday. Silver made a 61% retracement and then rallied 23 cents. Off the bottom, so it's still quite early. But if we get above that area of 1130, you're going to see one heck of a run. I think you're going to see it once it gets above 1108, because these hedge funds have gotten hurt really bad this year. We know that because Cargill's Premier Group, Black River, has closed operations, and some others have also closed operations, and even the returns on some of these things have been very, very poor, which I find that hard to understand, because they should have some technicians in there, and some of these things on the technical basis should be pretty easy to clarify, is what I would think. So we'll see what's happening. This is just to keep an eye on it. That's basically it. I haven't issued any buy signals yet for the 24/7 service that we have, but I'm certainly watching it very, very closely. I'm just being as conservative as possible. I'm watching the potential for silver as one of the things that looks really interesting because of the setup that it has, because it has actually had higher bottoms, and we didn't take out that low 1410, and that should have done that very, very easily. And we'll see whether that's going to be in the cards or not. So we got a big, strong rally going in stocks today. Looks like we're going to be, we got the NASDAQ up 44, the S&P's up 18, the Dow's up 170, gold's up $1, silver's up 6 cents. So it's a little quiet on the metals market area. Copper's still holding its gains. In fact, it's increased its gains. It's up 275 now, and the notes and bonds continue to weaken, which is not surprising because I think we hit some type of a major spot here in some of these things. We got Apple up $2.27. The bottom down there, we were looking at it at 114 in the Apple. That's where the ABCD pattern measured to. That was the extension of the move down, the ABCD down. We looked at that, and so far we've got a $3 rally off of Apple, during that time. Some of these others will rally a whole lot more, like Netflix and a few of the others, but remains to be seen what some of the others are going to be looking like. Overall, the overall stock bias is certainly bullish today, but longer term, folks, this rally like this is not how bull markets act. They don't come up and gap up 100 points in the Dow. They start slowly and build momentum and stuff, and that's the way I view it. Now, maybe if we get above 2110 in the S&P, then I'm going to have to say, this is all for naught, and we're probably going to make a new high. But boy, it's really set up with the advanced decline line, going lower. And if we look at the advanced decline line today, you're going to see that we're going to be watching a market that is going to certainly have, unless everything changes today, which I certainly doubt with this type of action, you'll see a big increase in advanced declines, just for the fact that it'll probably be 5 or 6 to 1 with shorts covering. Then the shorts will cover, very, very quickly, just like we think that could happen in the gold market. It's the same situation. It's just a matter of whether it's a gold, or the stock. So that's something to keep an eye on. Okay, now we want to take a situation here. We've had a question. Let's bring this question up, and that is about the. Oh shucks, I can't get it. Just give me 1 second here. It's about the euro. Just give me 1 second here, and I will get it ready. If I can find it. There we go. There we go. Just take a second here. We've had a little bit of good reaction here in the euro yesterday. Let's just put the hourly up. We can see it a little bit clearer and see it over a longer period of time. We've really haven't done anything to the bearish scenario of this at all. We had a move down, then we had another rally today that went up to the 50% retracement level in the euro. And that's pretty much, what we're looking at here is this situation where we're still in a downtrend. We've been in a downtrend for a considerable length of time, and we know that the long term. I'll do this one more time. I should do it all the time because I really feel strongly this is where we're going in the euro, and that is down towards the par level, or around 99. Whether this has anything to do with the Greece thing, I really don't think so. But the trend is still down, and we had that bottom in March, and we rallied virtually nowhere on the weekly charts, and that in itself is very bearish, because if it was a bit of good bottom there at the 104 level, the market would have rallied a whole lot more than 10 points, because every time it has made a significant bottom, it's rallied somewhere between 15 and 20 points, and this one only rallied 10, which is suggestive that the bottom is not very good. It's just a short-term bottom, but it's already lasted, 4 months, because it happened way back in March, and here we are, in the middle of August. So that's my opinion on the euro. The Australian dollar and New Zealand dollars, I think, have got a chance for some interesting moves, but we'll have to just do those one at a time and see if it's going to happen. But they've made some type of a bottom in all these things. That's another reason why it's real difficult, to be bearish some of these things. Now, if we take a look, we're going to take a look at one of the gold stocks that I followed over the weekend. There were two of them that looked. One is the one that Tom follows all the time, and that's Gold Corp. And it's also, give me 1 second here, and we will get it ready here. And you'll see that it's, oh dear, it'll give me 1 second. There we go. It'll take a little longer than 1 second this time. But we've had another situation where we had another big move to the downside. We'll come back. We're going to talk a little bit more about this gold situation, and we'll be right back after these few words.
Is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times Bull and Bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and I've posted the chart of the New York Stock Exchange Index showing the ABCD. Originally, I had that marked as the NASDAQ, and it was wrong. So this is the correct way. We've gapped up quite a bit. We're right almost to the, not quite to the 61% retracement. We've got the NASDAQ, of course, is the big daddy rabbit in the room, and it's up over 50. S&P's up about 20, and Dow's up about 170 early in the morning. So we'll have to wait and see, what's happening. This is pretty much what happened in China last night. As a matter of fact, one of the things that I wanted to do was to look at the FXI, because that's the Chinese ETF that I sort of follow. I don't trade it, but I follow it. And I believe we're coming up to, well, it hasn't even, oh my gosh, it didn't even open this barely opened higher. Boy, that's really not a very strong indication of anything going on. Is that correct? Wow, this thing didn't do anything. Boy, this is really a negative chart for the Chinese market. I can see why John Logan is so bearish this, because boy, this didn't do anything. I would have expected it to gap up at least 3% or something like that. It didn't even move anything. But anyway, the New York Stock Exchange Index is opened up in that area, and that's the one that really counts. And this is still early, and whether we're going to be up 200 in the 250 in the Dow today and up 75 or 80 in the Nasdaq remains to be seen. But these big moves that we're having are very, very indicative of something that's suspicious. Keep an eye on the gold and silver, folks. They're sleeping, but they're going to wake up and try to get on them, because I really think there's a real shot here. They're just not going down when they should have. The rest of the markets, especially today with copper making new lows at the 60, where making that big ABCD on the weekly and monthly charts, and the gold and silver couldn't even be down on the day. With that happening is a positive sign. And platinum making a lower low last week by less than $1 and then rallying $25. That's an indication of a pretty sold off market. So live every day in an attitude of gratitude and do something nice for someone who has a lot less than you today. Thanks for joining me.
Tom O'Brien has just announced a live online workshop taking place Wednesday, August 12th, 6 trades for September. This special event will be open to all subscribers to his daily newsletter, Market Insights. Tom will walk you through 6 trade setups in the market he's identified setting up for September. 2 long positions, 2 short positions, and 2 option trades. New subscribers will also receive a free copy of his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, an $88 value. But we're not done yet. We're also including a Tiger's Den membership as part of all Market Insights subscriptions at no cost as well. You get Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, 30 days of his newsletter, Market Insights, access to his live online workshop, 6 trades for September, and access to the Tiger's Den. This offer is only valid for 2 weeks, so don't miss out. Sign up for your 30-day free trial to Market Insights at the front page of TFNN.com today.